$4,625. That's how much extra tax the average small business owner pays each year. Why? Because they're missing these tax saving strategies. It's your friendly neighborhood taxman back again to chat about taxes. If you're new here, I'm David Mack. I run Box Advisory Services and I've been a chartered accountant for over 17 years, finding the best tax saving strategies in the Australian tax system. Today, I'm sharing my top 6 tax saving strategies. Specifically, reassessing your business structure, cash versus accruals accounting, timing your expenses, super contributions, leveraging the instant asset write-off, and maximizing your tax deductions. Let's dive straight in the first one. Reassessing your business structure. Most businesses start as a sole trader. It's because it's simple, quick to set up, works well when you're just starting out. But as your business grows, it's crucial to reassess if this structure still serves you best. And here's why. Sole traders are taxed at individual tax rates, which can go up to 45% for high income earners, whereas companies pay a flat tax rate of 25% for small businesses. This difference can make a huge impact on your after-tax income. For example, on $100,000 of taxable income, the tax savings could be a lot. And tax efficiency isn't the only factor that benefits you. Other structures like companies or trusts offer benefits such as asset protection, flexibility in profit distribution, and potential for easier capital raising. But it's not a simple decision and not one you should make only because you're potentially saving on tax. Each structure has its own complexities and compliance requirements. What works for one business might not work for another. You should consider factors like your current and projected income, plans for business growth, personal and business asset protection, succession planning as well. I usually advise our clients to review their business structure annually, especially if their circumstances have changed. I suggest you do the same because a shift in structure could lead to a significant tax savings and a better alignment with your business goals. The second way you can potentially maximize your tax return would be to look into your accounting method. A lot of business owners overlook this impact and how it actually works. For context, I'll give you a super quick crash course. There are 2 types of methods, cash accounting and accruals accounting. Cash accounting is straightforward. You record income when you receive it and expenses when you pay them. It's simple and it gives you a clear picture of your cash flow. Accruals accounting, on the other hand, records income and expenses when they are incurred, regardless of when the money changes hands. The reason why businesses go for this method is because it often gives a more accurate picture of the business financial health. For example, when you issue the invoice to a customer, that's when you incurred your income, not when you actually received the payment. But here's why the choice matters when it comes to assessing the tax efficiency for your business. With cash accounting, you only pay tax on the money you've actually received. This can be beneficial if the clients are slow to pay, as you're not taxed on income that you haven't actually collected. Accruals accounting allows you to claim tax deductions for expenses you've incurred but not yet paid. This can be useful for businesses with significant accounts payables. The best method for you depends on these factors: business size and complexity, industry norms, cash flow patterns, and plans for growth. For example, if you're a small service-based business with consistent cash flow, cash accounting might suit you best. But if you're a growing business with large inventories or long-term projects, accruals accounting could probably provide a more accurate financial report and potentially save you in taxes. Before we get into the next tip, I want to tell you about today's sponsor, Design.com. I always talk about marketing and branding being so important to think about early on in your business journey. It all starts with a memorable logo. And based on your logo design, you'll need to keep the style consistent across your business cards, social media, graphics, and website. But if you're not a designer, like me, getting something that looks good can be expensive and time-consuming. Design.com is an AI-powered design platform that helps you create professional logos in minutes. All you do is type in your business name, add a few keywords, and the AI instantly generates hundreds of logo options for you to customize. You can tweak them as much as you want for free. And when you're ready, you can download high-quality versions at a massive discount, up to 88% of your first logo when you use my link. On top of that, they also have an easy-to-use business card maker, website builder, and social media templates. Now, back to the video. My third tip is all about timing. We all know when the end of financial year is. 30th of June, if you've been living under a rock, use this knowledge to your advantage. For example, if you're using the cash accounting method, you could consider delaying jobs and invoices and payments until after the 1st of July. Obviously, there are anti-avoidance tax rules, so please speak to an accountant and ensure you're not participating in a tax scheme to avoid tax. However, if the income is not received until the next financial year, this means your taxable income for the current year will be less. But you should only consider this if it doesn't impact your cash flow severely. If you know you'll need to make tax-deductible purchases for your business in the near future, consider buying before 30th of June. This allows you to claim the tax deductions in the current financial year. You can also prepay up to 12 months of certain expenses like rent, insurance, or subscriptions, and claim the deduction in the current financial year rather than the next one. Let me just emphasize though, these strategies should align with your overall business plan. Don't make unnecessary purchases just for a tax deduction. The goal is to time necessary expenses and income in a way that benefits your tax position. Also, be aware that the ATO looks for unusual patterns in income and expenses, so make sure any timing strategies you use are legitimate and can be justified if questioned. Don't go buying a Lambo thinking you can justify this as a business expense, because normally it doesn't work. Now, if you were thinking about making extra payments to your super, my fourth tip is do it, especially if you got the excess cash or profit in the business. Any concessional contributions you make to your super fund are only taxed at 15%, which is almost always going to be lower than your marginal tax rate. Let me show you what this could look like. Let's say you're in the 37% tax bracket and contribute an extra $10,000 to super. You'll save $2,200 in taxes. $3,700 minus $1,500. There are a few conditions attached to these contributions. For starters, the ATO caps how much extra you can actually contribute at $30,000. But the good news is that if you haven't maxed out your concessional contributions in the previous years, you can carry forward the unused amounts for up to 5 years. This is particularly useful if you have a high income year. Now, on to the fifth tip. Leverage the instant asset write-off. The instant asset write-off is a tax incentive program that allows you to immediately deduct the full cost of certain assets in the year they are purchased and used, rather than depreciating them over a couple of years. The total cost of an asset must be under $20,000, but in previous years, it went up to $150,000. And fingers crossed that the government changes the rules in the future and bumps up the limit again. I'll give you an example on how this actually works. So I have a client who owns a bakery. Her annual turnover is $800,000. And this is the financial year she decided to buy a new commercial oven. She bought it for $18,500, excluding GST, in March this year. And then it was ready to use and installed by April. Since the oven is used 100% for business purposes, Sarah was able to claim the full cost of $18,500 as an immediate deduction in her company's tax return this year. Since the company tax rate of 25% applies, the instant asset write-off reduced her tax bill by $4,625. Obviously, consider the impact of your cash flow before you spend $19,999.99 on the asset for the sake of the asset write-off. Because while it provides a larger upfront deduction for now, it also means you won't have deductions in the future years for these assets. Okay, last but not least, the sixth way you can reduce your tax bill is claim all your tax deductions. This might seem obvious, but you'll be surprised how many people don't claim all their tax deductions
because it's too hard to keep track of.
Or it won't make that much of a difference anyway. I'm telling you, it's all worth it. Why wouldn't you leverage every single thing you could claim? And you can literally claim a deduction for most expenses incurred in carrying on your business as long as they are directly related to earning your assessable income. For example, you can claim your day-to-day operating expenses like office supplies and utilities, any purchases of products or services for the business, certain capital expenses like equipment, your motor vehicle expenses, travel expenses, plus repairs and maintenance and replacement expenses, and working from home expenses. I must mention though that the ATO is not going to give you the full cost back of all these expenses. That would be the dream, eh? You're just really using these expenses to reduce your taxable income. Let me show you a quick example to explain what I mean by this. We have a client who just started his own plumbing business, so he currently operates as a sole trader. His revenue this year was $120,000 and he earned $500 interest in his business savings account. So his total assessable income is $120,500. Here's a list of his tax-deductible expenses, which you can see adds up to $46,000. Essentially, now his assessable income is the $120,500 less the expenses, which is $74,500. So instead of paying nearly $30,000 in taxes, he's paying half of that. Anyway, that's all I have to share to you today. If you want to watch a more detailed video about how tax deductions work, because spoiler alert, you don't get all of it back on taxes, go check out this video here. All right, see you guys next time.